There is a bet by traders right now in the markets that yields will be 4% on Friday. But that brings us to what you need to know before the bell this morning. So tomorrow is the big employment day. And we've talked about before that bonds are very overbought right now. Bond yields very oversold. In fact, this is a chart of the 10-year Treasury yield right now. And again, we're pretty oversold here. We're deviated to the downside a good bit from the moving averages. Again, after we kind of took out these major moving averages, there's been a very nice move lower. We finished yesterday around 3.76% on the 10-year Treasury. There is a bet by traders right now in the markets that yields will be 4% on Friday. So that's a very big move tomorrow. And that would suggest that that employment report is going to come in a whole lot hotter than what markets are currently expecting. This is just what the bond market's betting on right now. There's just a big bet being put on of a move in yields back to 4%. Now that wouldn't be surprising. And first of all, I wouldn't expect that to happen in a day. That would be a massive move. It could certainly happen, but I wouldn't expect that. But as we've been saying, yields are very overbought. And so if we have a series starting tomorrow with a much stronger than expected employment report, we get a CPI report that's kind of ticks up a bit for whatever reason, that would not be surprising because yields have kind of gotten so overbought here, they need a reversal. So any data that really kind of puts some concern over where we are in terms of the inflation fight or the weakness of the economy, because this decline in yields is a bet on weaker economic growth and slower inflation. So any data that comes out that argues against that narrative will cause interest rates to move back up. And we should expect that to happen because, again, yields are very overbought. They've gotten ahead of where the actual data is. So there's going to be a bit of a reversion here, and again, we've talked about previously is that if you've been trying to get into, buying, I want to add some more bonds to my portfolio. I want to, I don't have any bonds. I've been out of that trade. I want to get into them. You really can't do it here. They're so overbought right now. This is TLT, so this is the price of the bond. And of course, it's the exact inverse of the yield. But again, very overbought, very deviated from long-term means. So we need something that will help pull that back here to provide us a better entry point. So talking about TLT, and which is the 20-year Treasury bond ETF, a pullback to around 95 on that index. So it closed yesterday at 99. So a pullback to about 95. That's about a $4 drop on TLT would actually give you a much better entry point to add bond exposure to your portfolio. Now, again, what gets us there, what causes it, causes that to happen, I don't know, but technically that's what the markets are telling us. And so if there's some, again, coming into tomorrow's employment report, we've got CPI coming out, we've got the Fed coming out in September later this month. If the Fed comes out more hawkish than expected, maybe they say, well, we're not going to cut rates right now for whatever reason it is, or just 25 basis points and the markets are hoping for 50. That could all lead to some type of reversal here in bonds. And I would expect that to occur. Again, bonds have come very far, very fast. And again, nothing goes up in a straight line. So look here for a correction. It doesn't mean it has to happen, of course, as always, but that's what the technicals tell us right now. And again, we're looking to adjust our bond duration as well. But before we can do that, we really need a better entry point. So we're just kind of being patient and waiting for that to happen. Anyway, that's what you need to know before the bell this morning.